All right, welcome weekly roundup, June 30th. We were just saying the end of the month, end of the quarter, end of the half, and it's been an eventful first half. Let's just say that.
Very. It was I think it's probably the worst start since 1970. So it's been a while.
Yeah.
A few years. Well, there you go.
Yeah. So what? Sorry, I'm a little slow on the gun here today, I guess. Yeah, rough start.
I think we leave it at that. Then not too much more to be said about it.
Yeah, I thought maybe you're going to expand on that, but I guess not.
Definitely,
you don't want to. You don't want to. Okay, let's move along then. So what were some of the things that grabbed your attention this week?
Yeah, I mean, I think that's obviously a big piece of what is being talked about right now. A lot of it has to do with where we are in the cycle. I did speak with some clients this week and talk about really kind of what the indicators are saying. And so I'll cover that a little bit in the chart section. Don't want to do too much, but so lots of charts this week that talked about where we are in the cycle, home sales, used car sales, new cars, inventories, all these kinds of things are coming out right now with pretty good data to make some decisions around. But I think primarily the best thing that we saw this week is that bonds rallied when stocks went down. And so that move from, I guess, 2 Tuesdays ago, from that 3.5 US 10-year to, I think we finished the week around 302 or something like that. 302, yep. So pretty serious move from the perspective that maybe the bond market is finally saying, okay, we think that we actually are in a recession or heading quickly in that direction. And so that was a real positive start anyways for the positioning on bonds.
Okay.
Yep.
So did you add to positions of bonds at all or no, or just held pat this week as far as portfolios are concerned?
Yeah, generally held pat. I mean, as I look at the information and some of the charts that I look through really give historical comparisons around where and how much the S&P is discounted where we are today. And S&P down 20 something ish percent wherever you take a look at that number. So if the market is forward looking, which I still think it is, it's telling you that we're headed that way. And the question is, how much is it discounting it? And I think the answer is probably 60, 70% of the move down has already happened. But I do think that there's a ways to go still. We have the Bank of Canada coming on July 13th with their meeting. And then in the US, they're later in July. But it'll be interesting to watch how that evolves and what Powell says. Powell spoke a couple times this week and, more of the same, that he thinks the economy is healthy, but now he's saying, hopefully we get a soft landing, but he's certainly changing his stance and view on what he thinks is happening, but it totally hasn't come through yet into the market.
Right. Gotcha. All right. You want to get your charts up there?
Sure.
While you do that, if anybody has any questions, you know what to do. The Q&A button at the bottom there. Just slide a question into there. Type your question there. We'll read it live on the air. Okay. How many charts do you have for us today, Ben?
Well, I wanted to put up 47, but I'm going to go with 4.
Okay. All right. Did we see this one the daily this week? No.
I don't think it was this one. I put Raul's slide deck for this quarter was quite good. So I did. I think I used a couple of them in the daily, but this was home builder sentiment versus home buyer sentiment.
Gotcha.
And if I did, it's possible, but that blue line is the home buyer sentiment. This is the US, and Canadian data is quite similar as well. But versus the home builder sentiment, and as I've said before, like this is obviously a massive divergence. And when you get these kinds, and this is back to early 80s, so this is a long chart in history to look at, including looking at 2008 here, where we had a kind of a divergence where we see today similar. Obviously, this is a bigger one now because the financial conditions tightened more aggressively than they ever had in history. So we got a big gap between what people are willing to pay versus what the builders think is going to happen.
Gotcha. Mm-hmm. Interesting.
Mm-hmm. So as I look at and try to kind of decipher the market versus the economy. And so ISM, which is the manufacturer's report, is really a sense of, each month how things are going. Are manufacturers feeling more confident and or are they feeling less confident? And it's a monthly survey that is a reasonable gauge for what's happening in the U.S. economy. And so the reason I put this up, and I did mention this and reference it in my daily, I believe today, where every time we approached 50 on ISM, and so we're coming down from kind of high 60s, and I think last month was 55, and this month is headed towards that 50 level. But every time since 1974, when we approach that 50 number, and if you average it out, it works out to be about 52. But when you approach that 50 number, the central bank has pivoted. So every single time this has happened, they have pivoted, which is stopping QT, quantitative tightening, where they, they start buying more of the bonds and going on pause, we'll say, not raising rates, and ultimately results in rate cuts. But why this is relevant is, as the economy slows, as we get recessionary numbers, every single time they cut rates, what that means is lower yields in bonds and higher prices in bonds. And so as I think about this and continue to look at this, I have much more even conviction than I had a couple of weeks ago that we're heading towards these levels. And, I think it's reasonable to go back and look historically. Some people want to talk about the 40s. This is like that. I think modern history, kind of the 70s and onward, is a reasonable look at for where we are. The major difference right now is that levels are materially higher. So I think their reaction function will be much more aggressive when they do change.
Okay, great.
And two more. One is kind of stock related. The last one is kind of further extension. I put in the daily a little bit on CPP today and saw another chart that was worth talking about briefly there. But this is really a look back at what happened in the tech wreck days, we'll say. And so that was the early days of my investing, professional investing career. And so I remember these corrections. Everybody wants to point to obviously Nortel and JDS and some of them that died or went sideways, but there also was a tremendous amount of opportunity that happened through that period. And if we remember kind of peak to trough drawdowns, these are reasonable things to look at, like Amazon, NVIDIA, and Apple. And then what happened after this, which I think is what we're trying to position for. I'm not saying all things are going to lift, but I do think there's tremendous opportunity. So Apple was down 78% peak to trough. Then over the next 19 years, it was up 59,000%. And so NVIDIA, 34,000, Amazon, 20,000, Adobe, 6,200. And Microsoft, which was the laggard, is still up 1,240% from those lows.
Wow.
Yeah.
It's an eye opener.
Yeah, it's a reminder sometimes that forest for the trees kind of thing, right? Sometimes you have to look a little bit past and see what's happening and where we're going. And when unique opportunities get presented, which I think a lot of that's happening right now, we got to be prepared to put some of that money to work.
Gotcha.
Yeah.
Last one.
So this was on CPP. Obviously, I referenced it in the daily. This was a different piece, but I thought it was interesting to think about. And so it is a material difference for when you take it. Yes, there's lots of things to think about around why and how and when you should do it. These are kind of the key factors that you should think about. Do you need the money? You are taxed. How long are you going to live? What other sources of income do you have? But there's a material difference between taking it at 60 and deferring to age 70. And so, if you take it at 60 with a kind of the maximum CPP you're allowed, that's a 9,600 a year for life indexed. If you do defer to 70, that number moves up to 21,361 index for life as well. Obviously, the key consideration is when you're going to die. Who knows? But I think it's interesting to think about, if you have other sources, maybe we should be taking some more money out of the RSP. Maybe we should increase the payments a little bit and just think about trying to defer that as long as possible, because there is a material pickup and it's indexed for life. So if inflation continues to be an issue, maybe deferring it makes some sense as we look at this. But thought it was a worthwhile chart, Raymond James, but they put out a great piece that I thought we'd share.
Yeah, good charts this week there, Ben. Good job.
Super. Thanks.
All right. Okay, let's have a look here. No questions yet. All right. Well, let's look ahead in the crystal ball. What are you seeing?
Yeah, so of course, and we're closed tomorrow in Canada. Yeah. So U.S. markets are still open tomorrow, July 1st. So we'll watch that. And then Monday is 4th of July. So we will, U.S. markets will be closed. So it'll be short week in the U.S. next week. I think there was a lot of attention around the previous quarters. We get a big rebalance into equities, and equities rally into quarter end. And we didn't see that this time. And so I think it'll be interesting to see where we go from here. Lots is going to happen in July with both central banks speaking the last time before the September meetings. So I think it's a pretty material month. Raoul did in his piece get the view that he thinks a pivot's probably June-July timeframe. Much more aggressive than I anticipated, but as I mentioned last week, some of the others that I've looked at based on the data that's coming in right now, maybe we're going to see that sooner than later. So be watching very closely, and I do have a shopping list of stocks I'd like to buy and get more aggressive on as things break down a little bit further, but certainly encouraged to see bonds picking up and encouraged to see oil rolling over as well. And so those two things are quite good and quite positive for where I see things moving. So I'd be continuing to watch and see how those progress next week.
Good stuff. All right. Did you have anything you want to finish up with? Wrap with anything to add?
I don't think so. We just, as we get into quarter end, have some clients that we've moved to quarterly reviews where we set up calls kind of on a 4 quarter out basis. So if that's something you're interested in implementing, certainly let us know. So we've been having setting that up in place, and that's had quite a bit of success around keeping people abreast at what's happening in their individual portfolios.
Yeah, that is working quite well. Scheduling system, so that's good.
Yep.
Okay. All right. Well, it looks like it's it. I am going to put out the video. We've been having a bit of trouble with recordings the last couple of weeks. We got this one out last week, but it was late. But I think I've got that figured out. So we'll have that coming to you either later tonight or first thing in the morning. Okay. That's it.
Super.
All
Excellent.
right. We'll talk to everybody next week.
Have a good weekend. Thanks very much.
Bye now.